Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we have a lot to talk about. We have the data that came out today. What does it mean? Where is this going as we head into Thanksgiving? And then what is happening around the world? Because when we look at OSPs going up, but yet some West African crudes not selling, and now some medium sweets, lighter sweets not selling in Europe. There's a lot to really kind of digest and understand. Where are the flows going? How are things shifting? And where are we on this gas to oil switching? Has it already happened? Has it slowed down? And we really want to go through some of those different factors. So one of the things that we want to look at with the data as it stands, it was fairly in line. That there wasn't anything too surprising. It was very close to kind of what we were expecting from last week. Small build in crude, Cushing small draw, but as we said, the pace was going to adjust. So Cushing had a draw of 3,000 barrels. Then when you look at where some of the different backdrops are, gasoline had a draw, but that's really driven by PADD 3, and PADD 3 had a nice spike in exports, and then distillate also had a draw. But when we look and kind of go through, well, what was the driver of it? Well, when you look at it, it still remains PADD 1, PADD 5, but we're starting to see some things come a bit more normal on the 5-year average, with only PADD 1 showing something below the 5-year average, which we really want to understand because that is important heading into winter, because PADD 1, especially PADD 1A, which is the Northeast, still consumes a significant amount of heating oil. So there is a lot to try to understand, and as we were also saying last week, we expected diesel to have a big makeup week on the demand side. We got that. Gasoline had a drop. We think that'll continue to slow as we head into Thanksgiving, and then have that nice surge as we go into Thanksgiving. And so far, we have now reopened and made international travel a bit easier. People have been able to travel internationally prior, but we're starting to open up more countries. And so far, we really haven't seen a big increase in TSA travelers, but it's only been 2 days. So again, we want to just look at how is this progressing? Is this really adding to, or really not changing much? But again, these are things that we're going to go through. So quick update on just what's happening in the U.S. So Phillips 66, for those that remember, we were talking about the Alliance refiner post IDA. They have now decided that they will not fix it, and they will just turn it into a terminal facility. So this is a quote from them. "We made this decision after exploring several options and considering the investment needed to repair the refiner following Hurricane Ida. Alliance's existing infrastructure and Gulf Coast location make it an attractive midstream asset. Phillips 66 will continue to be a major refiner with 12 facilities in the U.S. and Europe, but it'll just turn into just a loading facility." So we're going to lose a bit more refining capacity. And as we've been saying, and for those that subscribe to our insights, we still have a significant amount of refining capacity in the world. This is globally speaking. And more is going to have to come down as we do have new assets coming online in both China, Asia in general, and the Middle East. So this is not going to be the last one to see some reductions. But again, when we look at what is happening overall, they're just going to mothball it. One, it's cheaper. And two, you really can't get a new license for refiners. So this is something where if someone wants to come in and buy it, that's an opportunity. But again, this is just going to take down more refining capacity within the U.S., which just means that we'll need less crude, but we will need more product, because this is where we'll get some of these different shifts. So now when we go abroad and we look at what is happening in the total oil and product stocks, what's happening with land and floating, and then what's happening with total oil product stockpiles. So when we look at total oil and product stocks, we went from, we flipped to a deficit again. So we're just kind of hanging right around that normal, when we think of normal, we're talking 2017 to 2019 range. We're right around that 3-year average. Now we're about 16.3 million below. Before we were 19.4 million above, just based on what we've seen so far out of Fujairah, out of the U.S. and Europe. We should stay fairly fairly fixed around this line. When we look at land and floating storage, we're still in a surplus. It has gotten a little bit tighter, but when we look at what is happening with crude in motion, and that's just looking at crude on the water, there has been a fairly big surge. So we expect that to essentially go from transit into floating storage into onshore storage. So that will keep things elevated on the crude stock side. But then on the product stockpiles, things have continued to remain robust. There's been a widening of that differential, but as we were saying, we expect things to kind of flatline a bit here, and then the comps get a bit easier, but we still are in a fairly sizable deficit. But as we get new refiners coming back and increasing runs, it'll take down the crude side, increase the product side, and that's going to be the balancing act that we should see as we come further out of shoulder season. So then when we look at Europe, European imports of clean petroleum product from India are set to remain well above the year-to-date average in November. So 2 cargoes hauling about 160,000 tons of diesel continued. There's a third one on the way, with an additional 7 tankers are already sailing toward Europe, some sailing specific destinations, and they're all, again, slated to land in November, which is why that's important. And that's the other difference is when we look at what is happening on oil product stockpiles, that's just onshore. And then when you look offshore, there is a lot of that product moving around that will, again, go from offshore to onshore and increase some of that storage. But these are things that we're always going to look at and understand, where do we sit in that cycle. So then when we go into the just purely land storage side, here you can see land storage still in a positive spot. We had deficit widening from 26 to 37.5, globally speaking. When we look at the U.S. and the ARA, we're still we're in the bottom of that cloud, but again, still fairly firm in terms of below that average. And then east of Suez was the big driver. Now there was a lot of timing issues when you look at that east of Suez. We expect that to reverse a bit, and especially when you look at offshore, we expect some of that to go from offshore to onshore. But those are going to be things that are going to take some additional time. And with that being said, when you look at the Zhejiang petrochemical is cutting annual fuel production by 2.47 million tons after the startup of phase 2 expansion. And the reason why they're doing that, the plan is reducing annual gasoline, kerosene, diesel output by 960,000 tons, 1.29 million tons, and 220 tons, respectively. Production of ethylene feedstock and paraxylene used to make plastics will be raised. So you're getting some shift in Europe, in Asia, away from refined products towards petchems, and we expect to see some of that balancing act as some of these mega refiners come online, which they're going to need more land storage to do that. So that's where we'll see some of that pivot, a little bit less on offshore, a little bit more onshore, and that's just that timing delay on the east of Suez, while the west of Suez is going to continue to bump along below that 3-year average, just because of again where we sit on with Cushing, Pad 2, and where Europe is with more sitting offshore. And then when we look at Gulf fuel oil discount to WTI hits the widest in almost 2 years. So the high sulfur fuel oil discount to WTI on the U.S. Gulf Coast grew to its widest in almost 2 years as high natural gas prices discouraged refiners from turning heavy sour crude into fuels. So when you think about sulfur, you have to take it out of the system, and that's either a desulfurization unit, which is on the back end, or you try to do some at the front end, but that you can overwhelm those systems fairly quickly. Coking capacity is really the easiest way, most cost-effective way to do it, but how do you coke crude? But you cook it. That's essentially what it is. So you take a lot of natural gas to obviously create that flame, create that heat, and then it takes hydrogen to crack that crude. So when you look at just the underlying cost, the cost has continued to increase to turn sour crude into product. So the fact that sour crudes are expensive to crack, we should be seeing more demand for medium sweets, light sweets, heavy sweets, because sweet is just means there's less sulfur in it. So technically it should be easier and cheaper to turn that into product, which is why we talk so much about West Africa, Latin America, and realistically it's West Africa, because that is the first to post their loading schedules, because they have the best type of crude for what we're discussing. And these are some of those issues that we've called to light, because it's like, well, that should be in high demand. That should see that movement, because it's expensive to crack this crude, because you're seeing these wide differentials and that 3.5% sulfur fuel oil. You can't use that in the US. So you have to use ultra low sulfur fuel oil or very low sulfur fuel oil in some other countries, but you're not using high sulfur fuel oil. And that's where there becomes this opening, which is why we talk about the Atlantic Basin into Asia, why now we're going to start seeing this open up of the Gulf Coast into the Atlantic into Asia. 3.5% sulfur fuel oil discount to WTI on the Gulf Coast widened to more than $14, which is the most since January 2020. And again, it's the spike in natural gas. So Saudi high sulfur fuel oil production has also increased as cooling temperatures in the Gulf reduce power demand. Kuwait has shifted to becoming a high sulfur fuel oil exporter after their recent fire. So when you think about the movement of the shifting, gas to oil backdrop, a lot of the emerging market countries can use this high sulfur fuel oil. Obviously, it's not going to be used in the U.S. and Europe based on the restrictions on sulfur, but this is something that is in an advantage crude product that can go into Asia, but at the same time, it can also go into shipping as long as you have the key component, which is scrubbers. So these are, again, reasons why we hear the narrative, we're aware of it, but then when you start looking at the economics, you start looking at how refiners are reacting, you look at where storage is, you start to get this shift where there is more than enough product. It's just a matter of, is it in the right place? And then how much does it cost to get it into the right place? Which is why you see these widening discounts to essentially incentivize these movements into other markets. So now when we go offshore on the floating storage side, floating storage still remains well above normal, which is why when you look at the total, both floating and onshore, you get some of these big shifts. Now, when we look at total surplus widened from 32.7 million to 36.6 million. And it was really driven by west of Suez that had that massive spike. We saw big increases in Europe, and obviously they remain in West Africa, as we've been talking about, of the availability. The surplus widened from 3.8 million to 6.4 million. We don't see that changing. And then when we look at east of Suez, surplus widened from 37.2 million to 38.9, just because we had a slight uplift. But we expect to see that, again, be backfilled just based on the amount of crude that is floating and the amount of crude that is in transit, which we'll talk about in segment 3. So now when we turn to the U.S., here you can look at the DOE crude oil inventory excluding SPR. We are now dipping just below the 2018 level. And when we think about where we sit right now, we had a build of 1 million barrels. We're still 56.1 million below the 5-year average, but that is all just weighted towards PADD 2, where PADD 2 is 32 million below the 5-year, and Cushing is 26.4 million below the 5-year. And when you think about what does that mean when we start talking about PADD 3 and PADD 2, so PADD 3 and Texas and the like, they have a liquids tax. And the liquids tax, the tax man comes around in December and they start counting barrels because that's what you're going to be taxed on. So when we start looking at imports and when we start looking at storage, it becomes important to look at PADD 3 because PADD 3 is 9.6 million over the 5-year average. So as we progress further into December, what have we seen? We've seen crude prices spike. So you had imports coming. Well, does it make sense to now resell those because you can make a premium and you can start working off your excess storage to reduce your overall tax bill? And then at the same time, does it mean that you're going to leave more in Cushing instead of pulling it down because I want to show as little as possible so my taxes are lower? So these are the types of things that we're really looking at. Is it something that started a little bit earlier? Maybe, this is not this typically starts, let's call it the first or second week of December, but maybe it's starting a little bit earlier because they're trying, obviously pad 2 has more than enough storage and pad 3 has too much, just given what we're going to talk about in a minute. But that's when we're starting to see some of these shifts. Now, on the other side, when we start looking at clean oil products, November loading shipments of clean fuels from Asia to the Americas rose to 105,000 tons as of Monday, from 70,000 tons earlier, and we see that continuing to grind higher, even though China is restricting and cutting some of their underlying exports. Now, when we start looking at days of supply, they continue to grind higher. We have, and the reason why is because we've had crude stocks continue to move up, but at the same time, we have seen runs remain fairly depressed given where they are on a normal basis. They're 0.6% above 5-year average. We had an increase of 0.4%, 40 basis points from 86.3 to 86.7. We were expecting a move to about 87.5. So still a little bit sluggish, but again, we're starting to see some of that acceleration. But the build in crude and the fairly low run rates is, again, just increasing the underlying amount of days of supply within the for crude. But when you look at it, we're right at that 2015 level. We're still below where we were in 2016, but obviously below where we were in 2020. So Europe's gasoline exports to Americas remain weak. Diesel flows remain elevated, again, because of that PADD 1 backdrop. When you look at what gasoline in the PADD 1 is 6.1 million below the 5-year average. But we normally get slower demand just based on weather and whatnot, where we're going to start pulling in a bit more of that diesel. So then when we start looking at total exports, so total European exports to the Americas, mostly gasoline and blending components, are expected to be about 1.45 million tons, which includes 15 tankers that have sailed so far, with 20 tankers already booked. And then when we start looking at what does that mean going forward, diesel-type fuel shipments remain strong with at least 411,000 tons expected so far this month. A little bit further down from where we were in October, but we expect that to continue to remain elevated. Now, when we look at everything, and again, by everything, we mean just putting together crude oil stocks and products, you can see we're just kind of bumping along here right at the lows for 2021. We expected, again, just to kind of follow where we were in 2018 and 2019. Similar path, but at a slightly reduced rate. And it's just going to come down to when do imports show up. And based on what we're seeing in PADD 3, they may not. Or they may be reduced based on the fact that we're currently 1.1 million barrels a day below the 5-year average. So clearly, they're just looking to try to adjust and maintain their exports while also trying to reduce some of their total flows. And that's when we look at the underlying component of it all, that's where we want to see, well, what is the demand looking like? How is that going to flow? And so far, we just think it has a kind of that normal trend as we take some of that product and some of that crude and turned it into product. So now when we look at gasoline storage, this is where we normally start to get a pivot higher. It's usually the week before, the week after. So still nothing too crazy when you look at it on holistically. And realistically, we'll start to see that come back up and start to trend higher just along those seasonal norms. Now, distillate, on the other hand, continues to bump along the 2021 lows. And again, that is all being driven by PADD 1, which is going to be the concern. Now, diesel demand still remains strong. Diesel's still a bright spot in the underlying. Gasoline is something that we think weakens a bit. Again, nothing crazy, just a little bit below that normal, but diesel will continue to be the bright spot and be well above the average that we typically see. Jet kerosene had a big drop in total storage. Again, it can go into the disty pool, and if you're getting more money in the disty pool, it makes sense to put the kerosene onto that diesel side. So these are things that they're going to be playing with to try to manage some of that underlying flow. Now, when we look at the crude curve, through we're above 75 through June of 2022, which is why I think it's funny that some of these companies don't want to hedge. And again, we are not saying to hedge all production, but you were willing to hedge production at 45, but now companies are saying that they're not going to hedge when you can hedge at 75, which again, it's just a matter of maybe 25%, 35% instead of 65%. But these are things that I think will be considered as we go further into 2022, and to see how some of these estimates that we've seen from the STEO, from the or EIA, from the IEA and OPEC start to play out when we look at underlying storage, which we'll talk about in segment 3. Now, when we look at COVID net changes on the worldwide basis, they've stayed fairly flat. The U.S. has seen a slight uptick, but nothing crazy, where the biggest uptick has really been in Europe. And the reason why is because we've the UK remaining elevated, with Germany and Austria seeing the biggest uptick. And that's something that is being watched closely, because there's some calls, and again, it's going to be more provincial and state-based, not nationally based, but those are going to be things to watch, as we have South Korea ticking a little bit higher, as Thailand and Malaysia flatline a bit. But then when we look at India, when we look at Asia Pacific in general, and Japan, they continue to trend on the right direction. Now, when we just go a bit deeper into the crude stock build, here's their build of 1 million barrels. East Coast, small build of 180,000. Pad 2, small build. Pad 3, a small draw of 1.9 million. Pad 5, a nice build of about 2 million. When we factor in the SPR has had us at a draw of 2.14 million. But remember, things going from the SPR go into commercial storage. They typically go in as imports. And then, if you remember, we allowed some other countries, i.e. India is one of them, to use some of our storage. So there is some of that can also be recognized as exports, because we would export it obviously to those countries. But it's just a matter of where it's being calculated. Instead of it being in the SPR, it's in the commercial storage. So we still have a build of 1 million, but it's just when you factor in what is coming out of SPR, or the Strategic Petroleum Reserve, into commercial storage. There was a view that Biden was going to release some of that storage. The view was that it was going to happen following the STEO, or the EIA's updates. It came in a bit bearish, and by bearish I mean it had an increase in storage through and again, just less of a draw in Q4, and builds kicking up in 2022. So it was technically bullish storage going up, which should be bearish pricing, but that just meant that Biden lost the ability, or at least using that as an excuse to have a bigger release from the SPR. That sent crude up too. Now it's come back down again. It shouldn't have really gone up, but right now I think people are just using this as an excuse to pull it back down. And now when you think about what happened post-IDA, Shell is starting to bring back the Mars platform. So we will start to see a steady increase of crude coming into the production side. And we should close out the year at about 11.65, which is right just below the high end that we had of that 11.7 million barrels a day of production. Now, when we start looking at the mobility data, China has come through a floor, and that's just because there's a bigger COVID outbreak. COVID continues to be a big issue, especially when you're looking at what is happening in China, and how they have an increase of restrictions. We'll talk about that in segment 2 on the flight side, as Europe continues to slow. Again, a mixture of a little bit of an increase in cases, and just general, it's November, so things slow down a bit, as Google Mobility still has us just below normal when you look at where things were on the 7-day moving average. Again, just 7 to 12 to 7% below normal, while Apple Mobility is starting to roll over, but still has us a bit above average. So then when we look at Pad 3, we're just below where we were in 2016. So, obviously 2020 is this the top line. So as we continue to look, we should see things, they're going to try to bring it down below 2016. So when you look at, as you go into December, you can look at what happened in 2019. You can look at how 2015, 2017, you try to get that to drop so you don't have to pay as much in taxes. So again, these are things to watch that are structural as they try to avoid the tax man. When we look at Cushing, Cushing had a small draw, and again, this is what we've been saying, is that it's not going to really spike back up, but you're just going to see some of that slowdown and then a gradual increase as we head towards the expiration of the December contract. And now this is just looking at the 10-year. So here you can see we're still above where we were in 2014. But obviously well below where we were in 2018 when you had got low, and then you had that nice spike. Based on what we're seeing so far, it should likely move closer to where we were in 2011, where it's just going to start to kind of gradually go back up. But again, it's going to be a matter of how little is moved into pad 3 ahead of taxes. The fact that exports are going to remain difficult, you should lock some of that in a little bit higher. Runs, as we were saying, had an increase of 40 basis points, but it pulled a decent amount of new crude oil in of 344,000 barrels a day. Again, it all depends on the process that's being used. That's 284,000 below the 5-year average. And as we were saying last week, we expected pad 3 to be the biggest spike, and pad 3 was the driver of an increase of 356,000 barrels a day. We expect to see that continue to move up along kind of seasonal norms. So we do expect to see that 87 to 87.5 next week, or I should say this week, which will be reported next week. Imports had a big drop in pad 3, as again something that we saw the boats coming. They're still there, but maybe some of them are starting to get resold. Maybe it's just straight up timing, because as we were saying, we expected this to start in the second, third week of November. So it's just going to be a matter of when do they show up. We kept seeing them stall and just not come as quickly as we were expecting. And again, here we are on that level. Pad 2 again had a big increase of imports of 106,000 barrels a day. And even though that number isn't big, it's still a big number when you start looking at the 2 weeks of increases, and we expect that to continue. Remember, as Line 3 is fully operational, as we have more pull through. So pad 2 is 316,000 above the 5-year average. Pad 5, as we saw last week, we had that weird drop, and then we were saying that there was going to be a spike coming back down to timing delay. Pad 5 had an increase of 511,000 barrels a day, and that brings us 222,000 above the 5-year average. But Pad 3 had a drop of 472,000, which is 1.1 million below the 5-year average. And that's where we see the biggest concern of, well, when does that increase? Does it not increase? What does that leave us with? And again, Pad 3 is the one that is going to be that swing on imports. And applied demand had a steady drop. As we were saying last week, we thought gasoline was going to come in about 9.2. Here we are with a drop of 245,000 barrels a day, coming at 9.259. We thought Disti was going to have a makeup number, and here we are with an increase of 594,000 barrels a day, going from 3.68 to 4.28. So again, nice little pop. Jet, slow, steady decline. Again, we went from 1.68 to 1.59 million a day. We expect that to gradually move lower, while propane still remains strong. It had a drop of 133,000 barrels a day, but still well above a million. And just based on how the weather is shifting, that will also adjust what that looks like coming into the remainder of the year. Floating storage, again, starting to creep higher. We expect this to continue to trend up and be in the middle of the cloud. Obviously not getting back to the 5-year average, but still trending up. Pad 3 imports, huge drop. Now, it was still not at the lows for the year, but we were expecting one more move up. Instead, we got a big move down. So again, it's just going to be a matter of timing delay and so we should have a makeup number that should be pretty sizable when you're looking at where some of those moves are. And by sizable in terms of taking us probably above those highs, but still not to the highs of 2022, as Pad 2 sees another spike, moving to seasonally adjusted all-time high. And as we were saying, will remain well above the 5-year average and at the top end of that cloud, as refinery utilization rates, when we look at over the last 29 years, is following the same trajectory, just at a reduced level. So it's the pace is the same, but it's not at the same level of operation. And we just think that they'll start to close some of that gap as we head into the first week of December. So now that we've done that holistic overview, we're going to dig deeper into purely the U.S. and what is happening with U.S. demand, U.S. storage, and underlying refinery operation utilization rates.